You don't need to be poor to be trapped. You just need a credit card. Not the maxed out kind, not the obvious kind, the quiet kind, the one sitting in your wallet, making your life easier. Because the truth is, modern finance doesn't control you by taking your money. It controls you by giving it to you. Right now, somewhere in the world, someone is buying something they can't afford with money that doesn't exist from a system designed to make sure they keep coming back. And the strange part? It feels like freedom. Swipe, approve, done. No friction, no pause, no immediate consequence. Just a number that grows later. This matters now more than ever, because over the last 40 years, something fundamental changed. We stopped building economies around income and started building them around credit. In simple terms, people stopped spending what they had and started spending what they could borrow. And once that shift happened, everything else followed. Housing, education, healthcare, even daily consumption, all quietly restructured around one assumption: you will borrow. Let's break the system down. At the center of it all is a simple mechanism. Banks don't just lend money, they create it. When you take a loan, whether it's for a car, a house, or a phone, no vault opens, no pile of cash is moved. A number is typed into existence. Your debt becomes new money in the system. This is how modern economies expand, not through saving, but through borrowing. And that sounds harmless until you look at the incentives. Because once money is created as debt, the system needs more debt to keep going, not less. Here's where it gets uncomfortable. Imagine you borrow $1,000 at interest. That $1,000 now exists in the economy, but the interest you owe doesn't. So to pay it back, someone, somewhere, needs to borrow more money. And that cycle repeats. Debt creates money. More debt is needed to pay old debt. And the system quietly grows on obligation, not productivity. Now zoom out. Credit cards, buy now, pay later apps, student loans, mortgages. Different names, same structure. They all do one thing extremely well. They move your future spending into the present. And that's incredibly powerful because it allows economies to grow faster than incomes. But it also creates a dependency because once people get used to spending ahead of their earnings, slowing down feels like collapse. This is why financial stress doesn't always come from poverty. It comes from timing. You might earn well, spend normally, live comfortably, but your money is already spoken for. Next month's income is paying for last month's decisions, and next month hasn't even started yet. There's an irony here. The system markets credit as flexibility, but it reduces your options over time. Every new obligation narrows your future choices. Not dramatically, not all at once, just slightly, quietly, until one day flexibility becomes fixed, and the system is optimized for this. Not by accident. Think about how credit is designed. Low monthly payments, deferred interest, reward points, instant approvals. Everything is structured to reduce the psychological weight of borrowing. You don't feel the cost, you feel the benefit. Now, the cost arrives later. And when later comes, it doesn't feel like a single decision. It feels like a situation, something you're already inside of. Now compare this to how it's usually presented. Credit is framed as a tool. Build your score, unlock opportunities, access better financial products. And all of that is technically true, but it's incomplete because the same system that rewards responsible borrowing depends on widespread dependence. If everyone stopped borrowing tomorrow, large parts of the economy would slow down immediately. Consumption would drop, growth would stall, markets would react. So the system doesn't just allow borrowing, it quietly encourages it. Look at the signals. Pre-approved offers. Increasing credit limits. Zero down financing. These aren't random. They're calculated nudges. Because from the system's perspective, your unused borrowing capacity is wasted potential. And here's the deeper layer. Your behavior becomes predictable. Once you enter the cycle, your future decisions are easier to model. You'll prioritize payments. You'll maintain income. You'll avoid disruption. Not necessarily because you want to, but because you have to. Debt doesn't just affect your finances, it shapes your risk tolerance, your career choices, your ability to say no, your willingness to walk away. This is where control becomes subtle. No one forces you, no one tells you what to do, but your range of options quietly shrinks. And in economics, control doesn't always come from restriction. Sometimes it comes from constraint. Now, to be clear, credit isn't inherently bad. It can accelerate growth, enable opportunity, smooth out volatility.
But the system we've built around it requires constant participation, and that's the difference. A tool becomes a trap when opting out becomes difficult. So what does this mean long term? If economies keep expanding through credit, then total debt keeps rising, not just for individuals, but for corporations and governments too. And as that number grows, the system becomes more sensitive, more fragile to shocks, because everything depends on continuous repayment and continued borrowing. We've already seen glimpses of this, moments when credit tightens and everything slows. Spending drops, confidence falls, and suddenly what felt stable feels uncertain. Not because money disappeared, but because the flow of credit changed. So we end up in a strange position where stability depends on people continuing to borrow, and uncertainty begins when they stop. And that brings us back to you, not as a victim of the system, but as a participant in it. Every swipe, every loan.
Every delayed payment, small, rational decisions that make sense individually, but collectively, they sustain something much larger. So the question isn't whether credit is good or bad. That's too simple. The real question is, if your financial life is built on money from the future, how much of your future is already gone?